that is one of the big determining factors for, I think your first question, fixed or float. Because in the past, when everyone saw how low rates were for so long, the cost to get an interest rate cap was also extremely low. So we had historically low general rates. We had really low rates to hedge, and an interest rate cap is a hedging product. It's probably best thought of as insurance for a floating rate loan, where you can buy a third party product that lets you not exceed the maximum floating rate. So when you have something that's been historically low cost, and then when the whole rate and curve environment flipped, it brought along a lot of other byproducts and issues with that. And I would say from a new rate cap origination starting point, like our whole trading desk that puts rate caps on, they've been fairly slow because rate caps have gotten so expensive. Rate caps also, not only move with current rates, a forward curve, and volatility. There's a lot of different aspects and math that go behind it. But when you start layering on everything that we've been going through over the last 18, 24 months, it made rate caps astronomically expensive for putting a new one on. When we're talking about existing loans that had rate caps, generally rate caps had shorter terms, because you can pick, like, the strike rate is considered, where do I want to set that level of that insurance or that cap? And also, how long do I want to have it out there? So the longer you have that cap on, the more expensive. The lower the strike, the more expensive. The higher the strike, potentially cheaper. That's not necessarily something that the borrower gets to choose all the time. Sometimes that's a lender-driven purchase requirement. So they might say, you've got to buy something within this range. Could you buy lower? Yeah, you can, but we don't want it to go past this certain threshold because it's going to impact your cash flows, your debt coverage, everything else. As I mentioned, with the rising rates and the volatility, what happened was a lot of these agency products, like Freddie Mac, for example, they do require rate caps. They generally have you buy something at a minimum of 2 years when you put on the original loan. When you have that initial cap on, they have a service that runs kind of in the background where they make you escrow funds to buy a new cap. And what happened when the whole curve flipped was these escrow costs went through the roof, and it really impacted a lot of owner operators' cash flows where no one really expected it or budgeted for it. So rate caps from a going in standpoint are expensive. Rate caps from an existing standpoint where you have accruing escrows got really expensive. And what we're seeing nowadays is people trying to play the game of, what do I do? Or I've got $1 million, $2 million sitting in a rate cap escrow reserve account with a servicer, and I still have, 8, 12, 3 months left before I have to buy a new one. So you're really kicking the can out from the initial term that you might put the cap on to extending it and putting another one on. And that's what that escrow is there for. So what we're doing, and a lot of the guys on our desk, we're trying to look at how much is an escrow, how much time is left on that, and how much it would cost to potentially put one on now, starting in the future. And this goes a little bit outside of the course material that you're looking at, but we do look at a lot of forward starting caps that might kick in when it's actually due, and you can take advantage of some forward curve modeling where it might be lower, and it might be more advantageous to put something on now starting later versus waiting 6, 8, 12 months and putting it on then at market rates at that point in time. So it's a little bit of a game of almost like options trading, where you can figure out what your risk tolerance is, see what it costs now. Maybe you can free up and use those escrow reserves now and start that clock all over again versus funding an extremely high and expensive basket of cash just to reserve for a potential rate cap in the future. Dodging around to a lot of different things, very slow on new rate caps right now for new loans, just because new loan origination isn't really going on. And the cost of the hedge is very expensive, but we are working with a lot of borrowers that are going through the rate cap reserve headaches, and we're working on extensions of existing caps for existing floating rate loans out there.